Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Today, I am solo as a host, but I've got two special guests here. So we have a special, God, you know what? I'm reading this and I'm trying it again. All right, our phone number. Let's start off with this. Our phone number is 888-912-1190. Use that number to answer the trivia questions for our 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. And that certificate's actually worth $100. So that's pretty good. And our today's trivia theme is TV trivia. So we're going to get right into this. Now we have 2 special guests, Charlie Dobens and Jillian Sidoti. I pronounced it correctly. All right, now I'm going to give you guys, the audience, a little bit of background here. So Jillian is an attorney, speaker, and former college professor. She's written equity and debt offerings for all kinds of industries. Her client lists include Flip This House and Flip or Flop, very well known on TV. She's also the author of Crowdfunding, Myth Debunking the Myths Surrounding Crowdfunding. And Charlie is a multifamily investor, attorney, and mentor to family investors all around the country. And in 2020, they teamed up to launch the Multifamily War Room. So let me get right into that. What is the Multifamily War Room?
Well, what happened was Jillian and I have been friends for years, and I have been teaching and training multifamily investors for that time. And you know, the way it would work was with my entity, which was the Multifamily Investing Academy, I would handle the transactional side of the deal. Okay. And I would bring them up to a certain point, and then I would hand them off to Jillian. You know, when it came to the time to raise the private money, I didn't get involved in that. I made sure that my clients, my students, were protected during the transaction from soup to nuts.
Gotcha. Okay.
Passed it off to Jillian. And so after, you know, Jillian and I were talking, and she was seeing how fabulously successful I was with my program, she said, how can we work together? And that's when I said, you know what? The thing that this industry needs is more of a holistic approach towards building your multifamily portfolio. And that is some entity that can handle both the transactional side as well as the raising of the private money side. It's a one-stop shop. And that's when we came up with the War Room. And I'll tell you, it's been a blast. It's been fantastic. The clients are absolutely loving it. And it's really, as I said, Jillian, this is the best thing.
Okay, so Charlie, do you find the deals and do the due diligence, and then Jillian raises the money for them?
Well, no. So what happens is we assist our clients. And one of the things that we do differently now that we started the War Room is Jillian and I will invest with our clients in their deals. But what my job is, my clients go out and find the deals, and I help them through the entire transaction. I help them through the entire process. I look over their shoulders. No piece of paper leaves their office unless I've looked at it. Okay. And then after that, are you guys getting this? Or am I
no. Even though you're freezing a little bit on the video, we can hear you. And the thing is what's good is both of you are attorneys, so that helps.
They don't.
Yeah. See, me, I've had 6 years of high school. That won't do it. Okay. Go ahead.
Yeah, exactly.
So, okay. So the clients find the deals, and then they bring it to you, and you help them structure it. You do what else do you do with them?
But it's more than that, because it's not just about finding the deals. We also teach them how to find the deals. Like a huge problem people are having right now is they can't find deals, or they find a deal and they don't know if it's a good one or not. Exactly. And they don't know if it's a good one or not because look, we are in unprecedented times. Yeah. You don't know what's going to happen. Charlie and I were just looking at a rent roll the other day that was for a 220 unit property. 50% of the units in the 220 unit property had not paid rent, had some kind of balance, and 50% of those, so 25% of the building, had over a $10,000 balance.
Wow! All because of COVID.
COVID. Yep.
Yeah. Now and these are all multifamily. Is that your specialty? Multifamily. Okay.
Yeah.
Which was the darling for many years, and then suddenly COVID hits, and it's like, it's a little challenging in cases.
Oh, actually, Ed, it still is the darling because the demand for our product is still strong.
Everybody needs a place to live.
Right.
And that's getting, the barriers to entry in this industry are strong because of the government. And so, the demand for our product remains strong. Obviously, COVID's an issue. COVID's going to weed out those undercapitalized multifamily businesses, and it's going to provide opportunities for new investors to come in and take over those assets, like back in 2008.
Yeah, and I'm gonna guess that the lower end type is easier for someone to qualify, saying, "Hey, COVID, I don't have to pay because of COVID." Whereas someone who's in the higher end type of multifamily, big expensive apartments, where they ordinarily work from home, they can't just yell COVID and suddenly stop paying, right?
Well, the thing is, like you said, the C-class assets are the ones that we're really starting to see the delinquencies on. I've already seen a couple of my people have come to me and said, "Hey, I think I'm going to lose my property. How can you help me?" Yeah, and it's happening. We're beginning to see that flood start to happen.
Okay, and this is where this is a little knee in my craw here, is rather than just give people a bunch of stimulus money, why don't the government pay the rent for, right? Because you can't just give people money and then they go buy cigarettes with it, let's say, versus, the landlord getting his rent, because now the landlord doesn't, is in trouble. It's not, to me, it's not fair to hit the landlord.
So you're so right. And I had a client the other day on Facebook put an email out, and we'll talk about that after.
Exactly. We do have to take a break. Very good. You took the cue right there. And by the way, I go by Edward, not Ed. Okay. Here we go.
Hold on, can I say one thing? I want to tell you the reason why they don't give the money to the landlord, but they give it to the tenants, is because when they give the money to the landlord, they get one Republican vote. When they give it to the tenants, they get 200 Democratic votes.
That's a very good point. Okay, here is our first trivia question. And if you guys know the answer, don't answer until we get back from break.
Oh,
all right.
Cool.
TV trivia. Who portrayed the character? This one's kind of a hard one. Who portrayed the character of Charlie Harper after Charlie Sheen was fired from 2.5 Men? All right. Call this one's it may not be that easy. Okay, call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Stay with us. You are listening to The Best of Investing, and we are going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with my two special co-hosts, Jillian Sidoti and Charlie Dobens. Oh, I got that right. Okay, here we go. Here's our first trivia question. Who portrayed the character of Charlie Harper after Charlie Sheen was fired from 2.5 Men? Jillian, you got all excited. You thought you knew the answer.
I'm all doubting myself. Maybe I don't. I thought it was Ashton Kutcher. But
okay, so Ashton came. He didn't play the character of Charlie Harper, but he did take over his position. Charlie, what's the answer?
Oh, I was going to say Ashton Kutcher also.
No, actually, it's not a trick question exactly, because I said who portrayed the character. It was actually Kathy Bates. It was a hallucination to Alan, the other person, as a ghost, and he was trapped inside of a woman's body. That was a little bit tricky. The other two were going to be.
Oh my gosh! That one. Okay, you get to keep the suntan.
Yeah. I'll tell you what. The next question will be a little easier for us people.
All right.
For us people over 20 years old. Okay. All right. Jillian, you wanted to tell us the story?
Well, yeah. So the other day, it was just so funny. You were saying about, if they're going to give out this relief money, then the money should go to pay for essentials and for needs. And I had a client on Facebook the other day have a picture, and the picture was of television boxes. And what they said was they could not evict this tenant who was in their unit, even though they had gone to the judge several times. They couldn't get the tenant evicted. And the tenant themselves actually just ended up leaving, because they moved on or what have you. But they owed my client $8,000, and what they had left behind were television boxes. Like, these people had spent all their stimulus money on TVs and nonsense and not paying their rent that they owed $8,000.
But TV is essential if you're in lockdown, right?
Okay. All right. Let me add to Jillian's, because one time I was doing a due diligence property inspection on one of the properties. I walked into this 1-bedroom apartment, and it was a C-class property, and I saw the biggest television I've ever seen in my life. And I looked at it like, holy cow, I don't even have a TV that's in the property just said something that I will never forget. She said, well, you know what they say? Poor people have big TVs and rich people have big libraries.
Yeah.
Oh, wow.
Yeah.
Wow. That is, well, nowadays you get everything on your phone, but I get the point though. That's really good. I remember one time I had a property over in Oakland. I kind of took it over for somebody, and the previous seller had said, oh, by the way, this person hasn't paid rent for like 9 months. And okay. So we get in there, I get in my offsite manager, and they get in there, and she doesn't pay. And sure enough, we start the eviction process, and it goes a few more months, and then it finally gets in front of the judge in Oakland. And the judge, and then the tenant shows up, and then the judge says, excuse me, tenant, why haven't you paid the rent? It's just, I just don't have the money. I don't have any complaints against the landlord. I just don't have the money. And the judge says, okay, you can stay for free for 3 more months, but then you really, really, really are going to have to leave. Can you believe that? And it's a good thing I wasn't in the courtroom.
I can.
I would have said to the judge, you know what? You pay her rent then.
Yeah. Yeah. It's so easy. That's like a violation of the takings clause.
Yeah.
Constitution, for crying out loud. The government just do those things.
No. Hey, so okay, so I've got some notes here that were given to me. So you got a couple things here. The 5 secrets to finding money and deals even when you think you can't, and how to structure your multifamily deal. Take it away.
Well, the first thing is that you really have to understand that raising money is a business in and of itself. It's a business within your business, and you have to treat it as such. So the first thing you absolutely positively must do is figure out what system you're going to use in order to raise capital. We learn very early on in our careers that you have to, or as entrepreneurs, your business needs to be run on a system or else you're going to fail, right? E-Myth, Traction, all the books we read teach us this. Raising money is no different. So the first thing you really need to do is figure out the system that you're going to use in order to raise capital.
Yeah. Okay, are you talking about like a fund or a joint venture type of thing? Or?
Not so much that. That's part of the system, right? But really, like, what is going to be your approach? What is going to be your investment story? How are you going to get that investment story out there? What is it that you want to be to the world, to a world of investors? And it's just like, what would you want to be to your customers? Who do you want to be to your customers? It's the same thing as, what do you want to be to your investors? And then how are you going to take them in? What methods are you going to use? And then how are you going to treat them so that they come back to invest over and over and over again?
Gotcha. And you got to have your system in place. This is going to be the manager, the offsite manager, the accountant, the attorney, et cetera. Yeah.
Exactly. And then not only that, but then a huge thing that I always find people screw up, right, is that they say, oh, I want to raise capital, and this is what I'm going to offer investors. And then they take in the money, and they don't have any system for reporting back to the investors. They haven't set expectations appropriately for the investors. Like, for example, they just say, call me whenever you want. And then the next thing you know, they get 1,000 from 1,000 different investors on 1,000 different days, and they're not actually getting any work done. Whereas you want to set that system out in advance. Like, I will be doing a quarterly report to all of my investors via Zoom on the 15th day after the end of the quarter.
Now, do you
stuff like that?
Do you set up just strictly equity, or do you also set up maybe subordinate financing?
Oh, absolutely. You can do anything you want, really. I know that sounds really flippy floppy, but you really can do whatever you want. The issue is that, have you really considered what your business is and how you're going to put that out there, and what the perception by the investor is going to be, and what the banks won't allow you to do. So like Charlie and I just did a webinar the other day actually about your capital stack, and I just straight out said, most of the time you're not going to do some kind of debt fund. It's simply not going to work because the bank isn't going to allow it.
And just, Edward, the thing is, when you look at a property, there are 2 questions you have to ask whenever you're looking at properties. How am I going to get the deal financed? and what's my exit strategy.
Yeah. Yeah.
And that's going to have really set you down different paths right away as to how you're going to do it. And so, you know, you ask the question, is it debt? Is it equity? Or is it a combination of the two?
Yeah.
You know, that's what we do with our clients is we help them answer that question. We help them come up with the ideas to structure the deal so that it'll get past the starting gate line. And then they're off to the races after that.
Okay, when we come back from break, I want to ask you about cap rates that you're seeing, what kind of rate of return clients should expect, you know, that sort of thing, you know, based on the different kind of properties. All right, here's our second trivia question based on TV. What TV show was famous for the catchphrase, missed it by that much, missed it by that much?
Oh, I got it. I know
yeah,
it.
I knew. I had to throw you a softball question there.
Look,
Like I said,
Jillian doesn't know. Jillian doesn't know.
come on.
Yeah.
Well, she's only, what, how old are you, 20 what?
Oh my God.
All right, I'm going to ask him one more time. What TV show is famous for the catchphrase, missed it by that much? Not bad, huh? Okay.
Yep.
And here, I'll give you another hint. He used to say in a cartoon, come along, Chumley, let's go see Mr. Whoopi. All right.
Okay.
That's pretty good, huh? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. We always have to have fun here on The Best of Investing, because it's like a bunch of guys sitting around a bar having drinks without the drink, talking business, and the audience listening in. Audience, stay tuned. We're going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Jillian and Charles, or Charlie, as we say. All right, here's our second trivia question. What TV show was famous for the catchphrase, missed it by that much? Charlie, what's the answer?
Get Smart.
Get Smart. That's right. Very good.
I should have done by the way you said it.
That's right.
I've like never seen an episode of Get Smart.
Oh, see, I told you, you're too young for that. You know, John Adams. Okay, so when you're putting these, I'll call it a syndication for all intents and purposes. Generally speaking, I got to figure that the C-class apartments are going to give have a higher cap rate than the A units. But what kind of cap rates? First of all, where's your market? Because Charlie, you're actually in the East Coast.
Yeah.
What are you guys doing around the country, or are you?
Yeah.
Okay.
Our clients are all over the country, so we have a pretty good understanding of what's going on around the market, all the different marketplaces, the primary markets, the secondary and the tertiary markets.
I'm invested all over. I just invested in a deal in Chattanooga, Tennessee. I mean, I stopped actually counting because I do most of my investments passively, but I'm invested as a passive investor in over 4,000 multifamily units. And then I have other real estate investments as well. And you just really, to me, you just have to know where and what you're investing in. And so one thing I have stayed away from are the syndications that focus on C-class properties. I will invest in a fund that might have some C-class properties in them, but personally, there's just, to me, it's not my risk tolerant. It's just too risky for me. I've personally owned C-class properties before. I've made money in C-class properties, but it's just not for me. And that doesn't mean it's not for somebody else. I have one client who has like Goldman Sachs investing with him in C-class properties. So it's not that it can't be done and it can't be done well. It's just not my particular flavor.
We call it scratch and dent. Yeah. In fact, I started a fund with Mark, one of my main co-hosts on the show, called the Pacific Southwest Note Fund. And what we're doing is buying discounted seller carryback notes, primarily in Texas. And,
oh, wow.
Yeah, it's very, very specialized. And the returns that we're getting, we're actually, with this fund that we put together, the minimum preferred return is 9% with a target of 12. And 2 months ago, we paid 12.3 because we're
wow, that's fantastic.
And the best part is, even though these are like you would consider for the most part, most of the properties, C properties, not a single person has asked for a deferment. It's a whole different world in Texas than it is in other places.
Nice.
It's got its pluses and minuses, you know.
I owned, you know, you're talking about cap rates, Edward, and I have a joke that, and Jillian was talking about C-Class. I have a joke that I have a bumper sticker on my car that says, life is too short to own C-Class property. And when I say that, one of my clients like gets all wigged out. He says, I made millions on C-Class properties. Why do you say that? And I was like, yeah, I know. It's just, you have to understand what your investment strategy is.
Yeah.
And funny you talk about Texas. I owned a bunch of properties in Texas, and Texas is a unique breed, man. I'll tell you.
It is.
You can evict someone in Texas in 12 days.
Yes.
And so inexpensive, lawyers don't even do it because there's no money in it.
Exactly.
But the thing is, I'll tell you, Edward, every appliance I owned in Texas had legs on it.
Yeah.
Oh, man, they used to love me.
That's a good term. I like that.
Yeah.
It kind of depends. Now, here's the difference, though, is we're buying seller carryback notes, so people are not renting. These people own the houses. And generally speaking, they'll take care of it for the most part.
You own the notes. Yeah, that's a sweet deal.
Yeah, and I mean, but again, here's the barrier of entry, though, is huge because it costs us a fortune to solicit from the sellers who have the notes. It's very, very expensive. So we're setting up this fund. We're paying it as the management company, not the investor, and then we just hope to grow it to maybe 100 million or so. In fact, it's so funny because we actually have a waiting list because it's easy for me to raise $100,000 in a blink of an eye from clients. I mean, it took me, I don't know, 3 days to raise $2 million, right? The problem is these notes we're buying are 40,000 and 50,000, and so it takes a lot of notes to eat up that money. So we actually have like $3 million worth in the queue where I told people, I said, listen, I'll call you when we need your money, but it's not going to be for at least 2 months. Just the nature of the beast,
Yeah.
Anyway, I don't want to talk about that. Okay. So, although I did talk about it. Okay. So here, in fact, here's a question that was given to me by Ms. Kane, who got you guys on the show. How to ask for seller financing? So that's kind of that's. I assume are you talking about how to ask for a first or a second?
Well, no. The first is easy. Obviously,
you're gonna get bank financing, right?
Right. Here's the way you have to ask for seller financing when you're dealing with multifamily. You're going to say something just very innocuous to the broker. Is the seller willing to get creative? Period. And then just shut up. You never ask for a second mortgage. You ask for seller financing, but it's never in the form of a second mortgage because my number one rule is you must always remain in control of the deal. And if you ask for a second mortgage and the seller says yes, and you bake it into the purchase and sale contract, and then you go through the whole entire process, you're 2 weeks from close, and the bank says, okay, we're ready to go, we got it all set, but hey, we read the purchase and sale contract, and there's something in there about a second mortgage, and you're like, hey, yeah, isn't that great? The seller's going to kick in 5%. That's fantastic, but we don't allow second mortgages. Yeah. So now, 2 weeks before the close, you're 5% short on the purchase price, and you have to go back to the seller. Your money is hard. You have to go back to the seller and renegotiate the terms. Who's got control of the deal then, Edward?
The seller. Yeah, exactly.
So what you do is you ask for seller financing in a form that is satisfactory to the lender, period. Seller says, well, what does that mean?
Yeah. Unrecorded?
I don't know. Yeah, maybe unrecorded. Maybe we're going to create a special class within the LLC that owns the structure that looks, acts, and feels like a second mortgage, but we can't call it a second mortgage. We can't give you any foreclosure rights behind the primary lender. That's why they don't allow it. And that's why you can't get yourself in the hole. That's why I said one of the first two questions you ask when you're looking at a property is, how do I get this deal financed? And that's one of the ways you have to think about now.
That is very good. Hey, tell you what, we're going to cut to a break, but I like that. That's very good. All right, here's our third trivia question. This one actually is kind of hard. Which future musical superstar once appeared as one of Rudy's friends on The Cosby Show? So you have to go back to the 80s for the Bill Cosby Show. Remember that? Call 888. Okay, which future musical superstar was once appeared as one of Rudy's friends? Remember, Rudy was a little girl. She was 4 years old at the time. Yeah. All right. Call 888-912-1190. Stay with us. You're listening to The Best of Investing. We're going to be right back. Welcome back to the Best of Investing. Edward Brown here, along with Jillian and Charlie. Which future musical superstar once appeared as one of Rudy's friends on The Cosby Show? That was our trivia question.
Was it a guy or a girl?
It was a girl. And she actually sat on Bill Cosby's lap back in the 80s.
Oh.
Okay, I'll give it to you. Alicia Keys.
Okay.
Alicia Keys.
Oh, Alicia Keys?
I was going to guess Alicia Keys.
Oh! Well, Jillian, we'll give you credit.
No, actually, I said it. I said it before you guys answered it.
Oh, man.
I just kept thinking it's got to be somebody that's my age, because Rudy, I remember, was my age.
Oh, okay. So, well, you are a youngster, aren't you?
You were 4 during the Cosby Show? Holy cow.
Yeah. Yeah, exactly. That's pretty amazing. Okay. Jillian, question for you. Rates of return, generally speaking, when you're looking at these apartment deals, what kind of rates of return are you trying to gun for, depending upon the class of the apartments?
I'm not really, you know what I'm looking for? I'm looking for risk versus reward, right?
Oh, okay.
Yeah. So the rate of return, what I always get this question, and it's a trick question, because if your risk is higher, your return should be higher. So for example, I'm looking into doing a ground up construction investment here soon. And the risk for a ground up construction is obviously a lot higher than just buying like a Class A property outright. Sure. So my return has got to be higher for that particular property. So just to say what returns are you looking for isn't really the right question.
Oh, okay. So let's put it this way: for Class A apartments, multifamily, what kind of cap rate are you looking at, and what kind of rate of return are you looking for, cash on cash? Well,
again, it goes back to the market. Like if you buy something in a urban market, although again, COVID might change a lot of this. You guys up in San Francisco, we're already seeing those changes happen, because businesses such as Facebook are saying, you don't got to live here no more. Yeah. And you can move on out. And so we might see this huge flight from urban areas, even in A-class properties. But with that being said, I mean, I've seen properties that have done quite well that are only a 6% return on investment. And why is that? It was because it was completely leased up. It's a brand new Class A property. So it's really just about a matter of, are you selling the story to the investors appropriately? Because at the end of the day, I could say to you, hey, Edward, I've got a deal for you. 15% return on investment. You're going to make loads of cash. That means nothing. That means nothing. You don't know anything from when I say that. Sure. So you really need the story of the investment, and then the returns.
Well, a big part of that too is, when you look at like gross rent multiplier, that'll kind of tell you like what your expenses are and what kind of growth you're looking at. You'll be very, Jillian, where are you located?
I'm in Southern California.
Okay, so you'll appreciate this. In Northern California, when at the heat of the market a couple of years ago, if you guys will be amazed at this. Someone bought an apartment building at a cap rate of 1.3, and I'm looking at that and I'm going, you know what? And I go, you know what? I'll buy that all day long if the bank will lend me the money at 0.2% interest.
Right.
30-year fully am.
I've heard that about California. I mean, we see different cap rates, different types of properties all over the country. But I've heard horror stories like that one where people say that they're actually buying properties at a 0 cap rate just to get their money out of like China into an asset in the United States. They don't care. They just want to, they'll pay anything for it. So
good point.
I've seen some offering memorandums from some brokers where the only way you can get the debt coverage number to work is by putting 50% down.
Yeah.
That's crazy. That's just crazy.
And they kept raising the debt service coverage ratio. It was at one point it was 1 and 1.1, 1.25. 1.35 seems to be kind of the about it depends, I guess, on the property and the bank, but about 1.35 is kind of.
Well, the thing is, looking at, like Jillian was talking about, it depends upon the asset and what your flavor is. I say that the debt, depending upon the class of asset, the debt coverage ratio is a dynamic number. You know, you should never buy a C-class property with a debt coverage ratio less than 1.6. The debt coverage ratio is your sleep number. It helps you sleep at night. If you go out there and you buy a C-class property with a 1.25 debt coverage ratio, you are squirming every single night.
Well, and the thing is, a lot of banks are using a debt yield ratio, which is different because what it basically talks about is if the bank gets it back, what's their rate of return going to be on that? I've written some articles on this stuff. I'll share it with you guys later.
Yeah,
I don't want to bore the audience with all this technical stuff. So I've got a couple of quick questions here for you. So
yeah, Edward,
yeah, go ahead.
We don't do technical stuff here.
Okay, yeah. Well, our audience is very sophisticated. I want you to know.
Oh, well, sure.
Very, very, very sophisticated. Yes. So let's see here. Okay. Find out about private money if it's available. It's kind of weird. Find out how private money is available to you like never before. And if you structure your deal the right way, what is the right way to structure a deal? How best do you guys like to structure deals?
Okay, well, it's again, when you're looking at a deal, you got to look at the deal first, and then and as a sponsor for the deal, you have to look at yourself second. And this is how I always tell people to work this out. You start with what the deal's going to make, and then you back out what you need to make in order to make you happy. Because here's the thing: if as a sponsor, if you're not happy, if you're not sufficiently financially motivated, no one's going to be happy because you're just not going to be sufficiently motivated. It's just
totally.
You could say, "I'll do it for free. I'll work for free." It's crap. That's not.
Nobody does that.
No, you just won't. You'll psychologically, you're just going to self-sabotage. So don't.
Exactly. So now because you guys are sophisticated, I'm a little surprised to hear that you are willing to, it sounds like you're also willing to invest in deals where you're, call it a limited partner or a limited member in an LLC. Aren't you a little concerned that you can't control the deal? Once
Yeah, you better know.
Oh, yes. Okay. I like that.
Part of your due diligence as an investor is to vet the sponsor.
Yes.
And to really feel comfortable with that person. I mean, that's really, and even for those of you doing sponsorships, you got to feel comfortable who your investors are.
Yes.
It goes both ways. It really does. Yeah.
Yeah. I mean, I know like some realtors, when they're selling a house, if they find out that the buyer's an attorney, they'll try to figure out a way to not go through with the deal because they're buying a lawsuit so many times if they get to know who the attorney, not all attorneys, of course, but certain ones, unfortunately, few bad apples have really kind of cost people a bunch of money,
Oh, yeah, absolutely. And like, that's the risk you take though. So what's the trade-off? I don't have to be down at a job site every day.
True.
I get to lean on the person who is there, boots on the ground, and I get to go off and do other things. Yes. It's again risk reward. And what I tell my clients who get all nervous about what to offer their investors and they don't want to look greedy, what I say to them is, your investors, you must be so careful with your investors' money and treat it better than you would treat your own money.
Agreed.
Number one, I want to preface with that. But the second thing you have to remember is that your investors can always get more money, but you cannot get more time. So the time you're spending building this deal up and making it happen is more valuable than the money that they're putting in.
Excellent point. Hey, stay with us. The Best of Investing. We'll be right back with some closing comments. Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host, along with Jillian and Charlie. No trivia question, but Charlie, you were just starting to talk off the air, and I wanted you to start talking on the air about it, about vetting clients. And go ahead.
Sorry, Edward, I've already forgotten what I was talking about. No, listen,
vetting everybody.
When we broke last time, I was saying that you've got to vet that, as a sponsor, you've got to vet your investors, and as investors, you've got to vet your sponsors. And the way you vet your sponsors is by make sure you read the operating agreement of the deal. And that is once everything is consummated and everything's done, that operating agreement is what's going to govern over the whole entire company. So you've got to read it and especially look to see how much control do you have and the other limited partners, and how much control does the sponsor have? And under what circumstances can that shift? And so that's one of the biggest things. And I've seen three GPs, the three people in one group. One guy wrote the deal. Everyone else signed off on it. They didn't read it. And that guy screwed the other two over by keeping more than 51% of the deal. He was not in control. Yeah, it was terrible. I couldn't believe it. And
yeah,
so
my dad actually died in the office of a heart attack because of a deal that we're same sort of thing where he was a general partner, the other two were general partners together, and they screwed him and screwed all the clients. And he literally, I mean, he died, at age 53 because of the stress. So it's really tough. How often do you see a situation where the operating agreement looks really good from the investor standpoint, but the general partners or managing members of an LLC don't follow it?
All the time. That's one of the biggest problems is you don't see, and you go back to it as an LP, say, hey, you guys are supposed to report to us this stuff. We're supposed to have a vote. We're supposed to have an annual meeting. And they don't even comply with any of that stuff. That's just bad business.
So then what do? You get usually the operating agreement or the bylaws or something will say you have to get 2/3 vote or something to vote the general partner out.
Yeah, usually what we used to put in our operating agreements was 75% for cause. So you made it very difficult.
Yeah, because you don't want any willy-nilly someone to go, I could run this thing better than you guys. Because sometimes it's just a matter of circumstances rather than ill intent.
Yeah. And the thing is, too, remember, all the investors signed up with that one guy.
Yeah, exactly.
Everyone put their faith in him, and then some rogue LP thinks he's going to outvote everybody. That's not why things are set up the way they are.
Wow, that's pretty challenging. I don't want to end us on we got about another minute before we have to cut out. Let's have some happy stories. Give me some happy stories.
Jillian can tell you about our upcoming seminar.
Yes.
Oh yeah, I almost forgot. I was having such a good time. I almost forgot. Okay, so the deal is this, Edward. Charlie and I honestly believe there's a major shift in the market happening. We're already seeing it. We started off talking about it with how, we're looking at these rent rolls that are just out of control. So what does that mean for your listener? It means that there is going to be a ton of opportunity out there. Yes, and we want to be ready to take advantage of that. And the way you can be ready to take advantage of that is to know which markets to get into, when to get into them. B, know how to raise money and know where to raise the money from. And C, have a crystal ball. So our event is all about creating and deploying the crystal ball. We want you to come to our event to get your crystal ball and to figure out what market am I going to be in? How am I going to raise the capital? Where am I going to get
it? We have 15 seconds. Tell us, where's this event?
Online. Shifts happen .online. Shiftshappen.online is where you can find it. So we hope to see you all there.
Wow. Well, Charlie and Jillian, it's been an absolute pleasure. You guys did great radio, and we'll definitely have to have you on again. Don't you just love it?
Thanks for having us, Edward.
Absolutely. Hey, so before you go, you got to hear, usually we have thoughts for the day. This time we have puns for the day because we're so punny around here. Okay, I wondered why the baseball was getting bigger. Then it hit me. There you go. I knew we'd catch you on that one. And then what do you call a piece of toast at the zoo? What do you call a piece of toast at the zoo? Bread in captivity. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.